So you started researching how to invest in Australia and you keep seeing the words managed funds, mutual funds, index funds and ETFs coming up. Pretty much all of the funds. And it's getting just a little bit confusing and complicated exactly which one is which. Well, in this video I'm going to explain to you what each fund does, the key features, as well as which funds I personally own. Hey friends, welcome back to the Chow Show, where I make videos about personal finance, investing and saving money. Before we get started, make sure you smash the like button and subscribe if you haven't already. Let's start with the oldest fund, which is mutual funds. Mutual funds actually date all the way back to the 1890s and originated in the USA. A mutual fund is a type of investment fund that lets investors pool their money together. A fund manager will then use that pooled money and invest in a variety of assets, such as shares or bonds, on behalf of those investors. Mutual funds can be either passively or actively managed. If it's passively managed, then it's probably an index fund. And if it's actively managed, it's usually referred to as a managed fund. One thing to note is that the term mutual fund isn't that commonly used in Australia. Instead, we directly use the term index fund or managed fund. Mutual funds have several benefits, one of them being diversification. Most mutual funds will have a portfolio that is diversified across a variety of different securities. They might also even be diversified across countries or different markets. The second benefit of mutual funds is professional management. Instead of trying to track the index yourself or balance your portfolio, a professional fund manager will do it for you, of course at a price. Third benefit of mutual funds is government oversight. In most countries, mutual funds are regulated by a governing body. In Australia's case, this is the ASIC, which stands for the Australian Securities and Investments Commission. As I mentioned earlier, when we use the term managed fund, we're usually referring to an actively managed fund. This means that the fund has a hands-on approach with the goal of outperforming the market. Each managed fund will rely on their expertise and own research in order to handpick a certain number of stocks for their fund. Each managed fund believes that they have the special strategy to outperform the market. For example, the Magellan Global Fund seeks to invest in outstanding companies at attractive prices while exercising a deep understanding of the macroeconomic environment to manage investment risk. Meanwhile, ARK Invest aims to provide broad exposure to disruptive innovation. ARK believes innovations centered around artificial intelligence, robotics, energy storage, DNA sequencing, and blockchain technology will change the world works and deliver outsized growth as industries transform. When it comes to fees for managed funds, that will depend on the individual fund manager. You can typically expect a management fee of around 1%, as well as a performance fee that can vary from 10% all the way up to 20%. Now, a performance fee is only charged if the fund outperforms the market benchmark that it's set. Another cost you'll encounter when you invest in a managed fund is called the buy-sell spread. This is an extra cost that an investor pays when they either invest in or withdraw from a fund. Buy-sell spreads are usually expressed as a percentage of the unit price, for example, 0.2%. The purpose of the buy-sell spread is to ensure that investors that are entering or leaving the fund bears the cost of buying or selling the fund assets as a result of their transaction. Managed funds have a minimum initial investment, and this can vary from $100,000 to $500,000. In terms of performance, over the long run, most actively managed funds actually won't be able to beat index funds. The tricky part of investing in a managed fund is picking the correct one, which is why for most people it's much easier to invest in an index fund. Index funds are a type of mutual fund that was created by John Bogle, the founder of the Vanguard Group, which is currently one of the largest index fund providers in the world. While at Princeton University, Mr. Bogle conducted a study that found that most mutual funds did not earn more money compared to the broad stock market indexes. This special insight would later serve as inspiration for his creation of the very first index fund. As the name implies, an index fund simply tracks an index.
Okay, but what's an index?
An index is a way to track the performance of a group of assets, for example, stocks. Let's use Australia's most well-known stock market index, the ASX 200, as an example. The ASX 200 consists of the 200 biggest listed companies on the Australian Stock Exchange. It's usually the one that is referred to when they're talking about, the stock market on the 6 o'clock news, or whenever they're talking about the stock market rising or falling. If you invested in an index fund that tracks the ASX 200, its price would either increase or decrease based on the index. So, for example, back in March 2020, when the pandemic hit, the ASX 200 plummeted. As a result, your index fund investment would have also dropped. The main cost of investing in index fund is the management fee. This management fee is set by the fund provider, but is usually pretty low compared to managed fund and other investments. Like managed funds, index funds also have a buy-sell spread, but it's usually pretty low. Index funds have a minimum investment amount, and it will vary depending on the fund provider. So make sure you do your own research and carefully read the product disclosure statements. If you're interested in investing in index funds, make sure you check out my best Vanguard index funds in Australia video. I'll leave a link down below in the description box. Finally, we have ETFs, which stands for Exchange Traded Funds. ETFs are investment funds that have been listed on a stock exchange. This means you can trade them like you would shares in a company such as Afterpay or Tesla. Each ETF listed in Australia is given an ASX code similar to those of shares. It's important to note that there are ETFs for both index funds and managed funds. Some of the most popular ETFs in Australia include the Vanguard Australian Shares Index, ETF VAS, iShares S&P 500 ETF IVV, and BetaShares Nasdaq 100 NDQ. And some of the most popular managed fund ETFs on the ASX include the Magellan Global Fund Closed Class MGF, the AFIR High Conviction Fund OPH, and the Platinum International Fund PIXX. ETF have several features, one of the first ones being accessibility. Unlike other investment funds, ETFs don't have a minimum requirement of hundreds of thousands or even $1 million for a hedge fund. For most online brokers, you can purchase your first ETF for as little as $500. Fees for ETFs will depend on the fund itself. For index funds, you can usually expect a management fee of less than 1%, and for actively managed ETFs, you're looking at least a 1% management fee plus an additional performance fee, which can range from 10 to 20%. Do keep in mind when you purchase an ETF, there will be a brokerage fee, and this can vary from $5 all the way up to $20 per trade. Generally speaking, most ETFs have high liquidity, which means if you wanted to get rid of, aka liquidate your investment, say tomorrow, you could do so relatively easy. All you have to do is sell it on the exchange. If you're interested in learning more about ETFs, I highly recommend checking out my Best ETFs in Australia video. I'll leave a link down in the description box. So to summarize, mutual funds can be either an index fund or a managed fund. And both index funds and managed funds can be ETFs, aka exchange traded funds. As I mentioned at the start of this video, I'm going to share which funds I personally own. I'm currently invested in the Vanguard Balanced Index Fund, the Vanguard Index Hedged International Shares Fund, and the ARK Innovation ETF, ticker symbol ARKK. So when I first decided to invest in index funds, I was still very cautious and played it very safe by investing in the Balanced Index Fund, which is comprised of 50% shares and 50% bonds. Later on, I realized I was being too conservative for my age and personal situation, so I decided to invest more into the Vanguard Indexed Hedged International Shares Fund. And finally, after doing some research on ARK Invest, I decided to allocate a small amount of money to the innovation ETF ARKK in 2020. Thank you for watching. I hope you have a better understanding of mutual funds, index funds, managed funds, and ETFs. If you're new to this channel, make sure you hit the subscribe button for more videos about personal finance and investing. I also make a new video every Monday breaking down the most important business news in Australia and around the world. As always, an important disclaimer, I am not a financial advisor, this is not financial advice. This video and my channel is for general information only. As with anything in life, you should do your own due diligence and seek independent advice.